So good afternoon, ladies and gentlemen. Thank you very much for joining us in this breakout session on emerging markets. So emerging markets, they do plenty of things to the global economy. They provide commodities and natural resources for production. They're actually the manufacturing hub of the world comes from emerging markets mostly. They are the main source of global growth. Most of global growth comes from emerging markets. They provide investors with higher returns. They provide investors with diversification from the traditional sort of investments, but they also come with risks. And the risks can be general to all emerging markets, but they also can be specific to particular regions and countries and sectors. So in the next hour, we'll try and understand what's happening in emerging markets, where the opportunities lie, where the risks are. And the plan is to have basically 2 panels and a presentation. So we'll have the view from emerging markets, and we'll hear what the view is from emerging markets on emerging markets. We'll actually have a 10-minute presentation on machine learning in finance, which I'm very excited to hear. But first, we'll start with a global outlook on emerging markets. And for that, let me invite the first set of panelists to join me here on stage, and I'll introduce them once they're here. So thank you very much, gentlemen, for joining us on this panel. So we have Themistoklis, who is the head of EMEA Investment Office at UBS Global Wealth Management. We have Patrick Wu, head of macro and co-head of trading Asia Pacific and the Middle East at Crédit Agricole. And we have Benjamin Weg-Brossard, who is the co-founder and managing director of Global Counsel. So plenty of things to cover in a very short space of time. Let me start with you, Themis. So if I look at the global economy, I see interest rates that are rising, I see high commodity prices, I see rising political tension, and I see slowing growth. How do you see the global economy, and how does that translate into your sort of investment decisions?
Right. First of all, I just wanted to say it's great to be here. It's a region that is a lot happening. So you're talking about emerging markets driving a lot of things, so we are at the right region. But just going back to your question, you already mentioned a lot of the source of growth globally comes from emerging markets. If I look over the next couple of years, if I look at developed markets, we're looking for growth around 1%, give or take. If we look at emerging markets, we're talking 4+% growth. So clearly a lot of growth is coming from emerging markets. Where do we see the opportunities? But again, before I go into the tactical opportunities, you mentioned some of the risks. Of course, long list of risks. The debt ceiling in the US, inflation, central banks, geopolitics, so there's a lot of risks. The best way to deal with those risks, the way we advise our clients, is to have a fully diversified portfolio across asset classes and across regions. That's one of the best ways to deal with risks, because the risks we know, we can deal with. The ones we don't know are the more tricky ones, and that the diversification helps you quite a lot. But in this environment, there's still plenty of opportunities. So if I look at the global landscape in terms of assets, our preferences are with bonds versus equities. We think equities globally expensive, trading over about 15.5 times PE for a time when the earnings are stagnating. And we think that the US is most probably one of the most expensive markets, trading more than 18 times PE with earnings going nowhere in the short term. Within equities, though, we like emerging markets. A lot of that comes from the reopening of China. China itself should be doing well. We're looking at 14-15% earnings growth, but also other beneficiaries from that in emerging markets through materials, but also sometimes we need to look outside emerging markets for opportunities in emerging markets. We've been positive on European discretionaries. Within that, luxury is one of the biggest sectors, which obviously benefits quite a lot from the China reopening. So we're cautious on equities, but within equities, we like emerging markets. Out of the whole landscape, we actually prefer bonds to equities, because if you look at the income you're getting from bonds, for high-quality bonds, high-grade, investment-grade in developed markets, you're getting 4-5% yield. A lot of investors, they say, well, I can sit in cash and I get that much. Yes, but if the central banks start cutting interest rates, you're not going to have that opportunity a year from now. So this is an opportunity to switch from cash into bonds to lock in these high yields. So we like in developed markets, high-grade, investment-grade bonds, and we like emerging markets sovereign bonds. There you get even higher yield, you get 8% yield. Now, obviously, for a good reason, it's a more risky investment, but that yield more than compensates you. And lastly, if I touch on currencies, within currencies, the biggest sort of call we have is that the dollar already peaked and is going to be weakening against all the major currencies. And the reasons behind that is, if you look at the recent past, the US economy grew a lot faster than a lot of other developed market economies. That is going to narrow. That growth differential is going to narrow. The US is slowing down. And also, interest rates in the US most probably start coming down earlier than some of the other developed markets, so that differential is going to narrow. Again, that's negative on the dollar. The only other currency the one currency we definitely like is the Japanese yen, which has been very weak, very undervalued. The Japanese central bank has been very dovish, but at some stage, they need to sort of reflect the fact that the economy is doing better, inflation is picking up, and the fact that they've been all buying all the Japanese bonds. They got 52% of all the outstanding Japanese bonds. So at some stage, we believe they're going to move away from yield control, and that should be beneficial for the Japanese dollar. A quick summary.
Sounds great and comprehensive summary. But if I focus on this sort of the subspace of that, which is emerging markets, because you talked about bonds in Japan and advanced economies, you talked about currencies in Japan and other advanced economies, you talked about bonds in other economies. If I look at the emerging market space, last year was just very difficult for most emerging markets currencies. I think most of them declined against the dollar. The Fed was raising rates aggressively. Bonds weren't doing great. I think at the end of 2021, you had 8 countries in distress. Today, we have 16, so double the number of distressed countries with distressed debt. Within the emerging market space, is there any particular places that you like?
If I look at Asia, the countries we like, China, Thailand, and Korea, for different reasons. China is reopening, and we've seen it in all the statistics. If you look at mobility statistics already 2019 levels, so the reopening is happening. The main beneficiary is services, but the economy is clearly doing well, and that will be reflected in the earnings for the companies. So we like China for that. We like Thailand to some degree because of the China reopening, because that is going to help the tourism sector in the region. And we like Korea because they have a big exposure to semiconductors. We think that sector is bottomed, and we do see a recovery in the cycle, and they are big beneficiaries, and they export obviously to China as well.
That sounds great. So let me move to Patrick. So one of the key themes that we heard from Themis is the China reopening, and in the interest of creating conflict here, Themis is very bullish on China. He thinks the reopening is happening. And obviously, it was focused on the services sector. I was looking at our chief Asia economist, what she was writing about China, and she had a headline, China's reopening is sputtering. How do you see China reopening from your vantage point in Hong Kong?
Thank you. First of all, I'm glad that, Tamis and I, we are liking the same thing. So going back to the China reopening, right? I think the whole world, we were so excited last year before the China reopening. So in Q4, you have seen the equity index in Hong Kong, Hang Seng Index, rebound by more than 50% from the low. But after Q1, we have seen actually consumption, the trade didn't really pick up as what we have expected. So it's affecting, some of the other labor countries, including Korea, right? Because the Korea trade didn't improve as they expected. So to be fair honest, I think the expectation on China reopening has been priced in. And right now, the trade is almost over. So let's face the reality. In last year, we have seen the social deposit in China grow by more than 18 trillion. This is more than $2 trillion US. So the new normal is about, the Chinese people, the people in the region after COVID, they are changing the way how they consume. They are changing the way how they travel and how they do business. So the good side of the reopening is there are more Chinese companies. They start to explore. They start to reconnect with, the emerging markets, with the global markets. So we see some of the corporate in China, right, they do have the plan to expand their production line in Vietnam and Thailand, and right now they can travel there, they can travel to the Middle East to explore the investment opportunities. But at the same time, I still see there are restrictions regarding outbound investment. They are still concerned regarding outbound investment and also, the deleveraging which is happening in onshore China. And that's why this is making the reopening trade not as optimistic as what the market they have expected. I also would like to say something about what Tammy just mentioned. So I still are quite bullish on the China investment or the emerging market investment as a whole. First of all, in China, right, the equity valuation is very low. Price to book for a lot of big Chinese banks, we are talking about 0.44, that kind of valuation. If you look at the dividend yield, it's higher than 5%. But if you look at what's happening in China right now, when I was in Beijing, I have some friends telling me that, right now, we don't have enough local currency assets. In those days, every one of us, we are seeing China as an investment market. But have you think about it? We should think about China as a funding market in the future. Because with US terminal rate at 5%, right? Right now, the China deposit every 1 year is at 1.5%. We are seeing, a lot of commercial banks, they cannot fund local currency assets in onshore China. So right now, we are seeing a huge tendency for Chinese investors to explore the global fixed income market. So they also would like to buy Korea, they would like to buy Middle East, they would like to buy other EMs, including Eurozone and other DMs. So I've also seen the Chinese regulator, they are trying to relax a lot of regulations on the capital markets. For example, in old days, if there are foreign companies who are about to issue a panda bond, local currency denominated bond in onshore China, basically it's quite difficult for the issuer to bring the proceeds outside China. But right now they change the rule, which means that going forward, right, if there are global investors, global capital markets player, if you are considering about getting funding, tapping capital markets, right, China may be one of the destinations. And it become much easier. And last week I was in one of another summit. Basically, China also opened up the onshore interest rate swap market. So you make the hedging on a lot of financing activities, investment activities much more easier. And that's why the reopening, right now, I don't see the impact is as big. But right now, I do also see the regulators, they are keen to build up the infrastructure connecting with other markets.
What is the thinking behind this opening of the capital account in China? Are they trying to, there's always been a question as China grew, the capital account is restrictive. Are they going to ease some of these restrictions? What is the thinking with, the policymakers are thinking there? Are they trying to make the yuan more of an international currency? Why are they opening up the capital account in the way that you've mentioned?
Of course, making RMBs as an international trade currency, right, is the final destination of the Chinese regulator. But they all know it's very difficult. It's extremely difficult. So right now, they don't want to open the market, open it up to everyone one time. But, they are trying to build the infrastructure over the time to see, how China can connect with the world. So let's say they have been building SIPs to make sure RMB can be settled on different platforms to facilitate all the trade among all the corporates. And that's why whatever policy that the Chinese regulator, they have been launching, right, I see the purpose. And they also would like to control the risk sitting there because they don't want something like, there are Chinese financial institutions putting on leverage on global assets. They speculate on other assets, which may create systematic risk. And this is why I would say they are trying to develop, they are trying to open up under a control mode.
Thank you. Benjamin, you look at Southeast Asia as well. Is it mainly a China story, or do we see ripple effects, for example, from the conflict between Russia and Ukraine? And what do you see there? Who are winning from these global trends? Who are losing from that?
Well, I think Southeast Asia in particular has been able to take advantage of the challenges that China has faced over the last few years. And I think that's really for two reasons. The first is that Made in China, that was once a brand that characterized the opening up of China from the 1970s, has now to an extent become a problem for Chinese manufacturers, where once exports could be simply sent from China out to the rest of the world, as China has sought as Chinese firms, if not the Chinese government, have sought to de-risk their own companies and their own platforms, they have to now see Indonesia, Thailand, Malaysia as factory floors in a way that in the past they would have seen southern China. And if you look at the data, if you look at the growth of intermediate products going into Southeast Asia, significant rises in the last few years, which is clearly a function of the fact that Chinese companies want finished goods to be coming out of Southeast Asia, albeit from Chinese businesses. So that, I think, would be the first point. The second is that emerging markets, and Indonesia, if you look at its ban on nickel exports, its easing of labor laws, its opening up to foreign investment. Southeast Asia, in Indonesia, but there are many others, have become much smarter in playing this game. So you've seen companies like CATL establishing major battery production facilities in Indonesia, inconceivable 10 years ago. You've seen big Chinese firms come in seeking to power Indonesia's drive to electric vehicles, again, inconceivable before the crisis. I was in Jakarta a couple of months ago. I hadn't been there since before the pandemic. The city has been genuinely transformed. They've totally, completely got religion on EVs and on the energy transition, which is astonishing for a country that coal kind of runs through its veins. And so I think Indonesia certainly is going to be a winner, but as Temi said, you look at Thailand. Thailand, incredible economy. They're still raving about an article in the FT a couple of months ago about the strength of the baht, which they take now such pride by. If you look at, I think it's one of only 5 countries that's genuinely self-sufficient in food. It has, when the tourism market comes back, 15% of GDP is a function of tourism. So I think across Southeast Asia, you will see real uplifts. Who are the losers? If we're talking about geopolitics, I think the most obvious losers at the moment will be countries in gas exporting or in oil exporting regions that don't have their own resources. So you look at the challenges now in Lebanon and in Egypt, and in sub-Saharan Africa, which is a focus of food inflation. 30%, 40% uplift in food. The IMF reckons that GDP across sub-Saharan Africa will be down by about 4% because of the challenges that food inflation has posed. And so you see some countries being able to navigate this well. So Ghana renegotiated their debt with the IMF last week, a $3 billion package, and Zambia has been trying and failing to do that for the last 2 years.
A lot of the factors they mentioned seem to be driven by politics, right? So the rise in food prices happened as a result of Russia's invasion of Ukraine. The increase in energy prices, it wasn't fully, but partly also a result of the war. And obviously, we've got the tension between the US and China, and Taiwan is it. How do you factor politics into your thinking?
Well, politics is like the weather these days. You just have to deal with it. I think that for investors, clearly they need to understand what's going on. They need to, political risk 15 years ago was the oil minister in some obscure country in the middle of Africa going to be running off with the state treasury. Now, political risk is absolutely embedded into every CEO's dashboard in a way that it's never been thought of before. So you have to follow it, you have to understand it, and you have to keep ahead of the game. There's no way of avoiding it.
Can I just come on this, on geopolitics? Because obviously, it's the stuff that makes the headlines. And it's the things that attract a lot of attention and a lot of questions. I'll tell you how we think about it. Geopolitics are important in the micro level, often. In the macro level, not as important. You mentioned energy prices and the war in Ukraine. Oil price was already going up before the war in Ukraine. There was a spike when there was uncertainty what happens to supply. Russia is producing more oil now than before the war. If we look at gas prices, despite the fact that Russia stopped supplying gas to Europe, European gas prices are below than before the war, right? So food prices and food inflation, a lot of it is blamed on the war. But think about the commodity, the food commodity, corn or whatever you're looking at. What do we consume? We don't consume it in the raw form. We consume it as a meal at the restaurant. the percentage of the cost of the commodity is tiny. So a lot of what we've seen in price inflation often is labor inflation, much more so than the commodity. So sometimes these things get exaggerated, the impact of geopolitics on the real economy. So we always, when we're faced with that, we always try to move away from the headlines and the noise and try and understand what is the transmission mechanism into the economy. How is that going to affect the economy? And ultimately, the way it affects the economy will affect the markets as well. And it's an interesting thought process because that does away with all the noise and everything. At the micro level, clearly can affect a country, right? And that's why, going back to my initial statement about diversified portfolio. If you were a Greek investor that invested in the Greek market at the top of the market, would take 30 years of the market growing by 5% per annum before you make your money back, right? That idea of home bias because you know your market or whatever, very dangerous.
No, that's a fair point. So basically, interestingly, you're saying the geopolitics, we see it more in headlines than the impact in financial markets.
Even what we talk every day now between China and the US, right? And it's in the headlines all the time. If you actually go into the detail, a lot of these actions are very targeted. There's an easy way for both countries, if they really wanted to go aggressive, to do damage on the other economy. They don't do. There's a lot of American companies operating in China, right? It's not in the interest of the US to be too aggressive with China. China has counteractions to the US, very targeted, but it makes the headlines. And I'm not saying there's no impact. If you look at technology companies in China, got affected by some of the actions in the US. But again, I think if you look underneath, the impact is not as big as the headlines would imply.
Sure. At the risk of creating another exaggerated headline, I want to ask Patrick a question, and maybe I'll get the other panelists' view as well. So China is central to a lot of the things that we said, both in the short term in terms of its reopening, but also longer term. You know, the whole BRICS story, some people argue, is mainly a China story, emerging markets. And looking ahead for China, but more in the longer term, where do you see China? There's a view that thinks that China will overtake the US as the world's largest economy by 2030s or something. And there's a view that looks at issues in China in terms of debt, in terms of demographics, and they say, look at Japan, it's stagnated, China will reach that destination as well. Where do you think China will end up? Is it going to overtake the US or is it going to end up like Japan?
I think, first of all, there's no doubt, right? Right now, the biggest two economies in the world will be China and US. By looking at the economy structure, the structure of the capital markets, I don't think the Chinese financial institutions, they will develop into US FIs or nor Japanese FIs. As I mentioned before, because there were capital account controls, there are, regulations, and the regulators, they're looking at how they open up. And that's why, in the past, right, I think the leverage of the Chinese investor or the Chinese financial institution on the global markets, right, were limited. At this moment, like I mentioned, because there are lack of onshore local currency investment opportunities, so they are looking at investing in offshore market, in the global markets. So by looking at this, right, you will find out that actually the setup of the whole capital markets for China is very different from US or Japan. So in the next few years, I still don't think they would try to open up very quickly. They will still try to manage their own pace to, build more infrastructure. So whether China economy is becoming number one of the world right now, to me, right, I don't think it's the concern of the Chinese government. To them, right now, onshore market, you see the inflation in China by our estimation, right, end of this year, it should be at 1.5%. So this is a number which may surprise you, because we don't see the price, even during the COVID period, right? The price for food, the price for petroleum, the price for consumer goods were fluctuating very, fiercely in onshore China. I think the government, they have been controlling it very, very, in very details. And right now, this is also a reason why, because of geopolitics, because of deglobalization, and that's why the corporate and the layman's, right, they are, they're not consuming that much, they are not investing that much. And this is pushing the Chinese capital markets to further develop, to further build the infrastructure.
Okay, thank you. Benjamin, final word with you. How do you see the future of China? How does that impact the region that you look at?
Well, I think I would encourage you all, if you haven't, to take a look at Jake Sullivan, who's the National Security Advisor to the President, his speech last week in Washington, because he described a new Washington consensus, specifically looking at how the US should approach China, and being very explicit now that the US economic and foreign policy is now explicitly designed to delay the further rise of China in a handful of very significant economic sectors, but also, interestingly, talked about how it was now an explicit goal of US foreign policy to boost and support neighboring economies. Now, if we go back, and he named Southeast Asia, Brazil, and others. Now, if you go back to the Cold War 30 years ago, there was never really an economic component within the Cold War. Sure, there were a handful of dams built in Africa, there were a handful of bridges built, but nothing like you have today. And so I think what we're going to see now over the course of the next cycle, as I say, is an explicit part of US foreign policy, in part driven by things like the Belt and Road Initiatives and others, major spending plans to support and boost Chinese neighbors with the explicit objective of supporting US foreign policy and delaying their further rise.
Thank you so much. Thank you, gentlemen. We're out of time, unfortunately. We've got a lot to discuss, but very little time. Please join me in thanking our panelists for their views on this panel, on this session. Thank you. And let me invite my colleague, Gary Kazantsev, to talk about machine learning in finance on Bloomberg.
Thank you, ladies and gentlemen, and it's a pleasure to be here for the first time at the Qatari Economic Forum. I'm grateful to have been given the opportunity to talk to you about artificial intelligence, which has been on everybody's mind, it seems, for the last 12 months or so. Right? I think probably our organizers felt that this fits most appropriately into the discussion of emerging markets, because this is another way that the markets are being disrupted. That's my guess. So I have been with Bloomberg for over 15 years, and I am responsible for the technology strategy of our quantitative products in the CTO office. For most of that time, though, I was part of our engineering group, where I started and ran our machine learning engineering group, which is now called AI engineering. So we have been responsible for most of the client-facing applications of artificial intelligence, both in the Bloomberg terminal and in enterprise services. And in the course of product development over the last 15 years, we have learned quite a lot of interesting things. So today, I'm going to talk to you about the current state of the art. I only have 10 minutes, so it's going to be necessarily brief. And I'm going to illustrate some of the things that I'm talking about with the things that we have built for our clients. Now, no one here, I think, needs an introduction to what Bloomberg is. Everybody knows us as a media company or as a news agency, but fewer people know us as a technology company, which is what we really are. And as a technology company in financial services, we had to contend with overwhelming and ever-growing amounts of information ever since inception of the company 40 years ago. We are living, all of us, right, at the intersection of several very interesting exponential curves. One is the exponential curve of ever-increasing computational capacity that we have access to. Another is the exponentially growing amount of machine-readable data that we have to contend with. And third is the resulting ever-growing rate of change, which is fueled by ever-improving channels of communication that we have. So to put this in some tangible perspective, just to give you an idea of where is this going, and I had to estimate this for another talk just a couple of weeks ago, the cost of computation, as in per computational step that your machine makes, had declined by 30 million, a factor of 30 million between 1990 and today. Right? And this trend doesn't seem to be slowing down anytime soon. As Jim Keller says, he was a designer of some of the original chips for Intel and IBM, Moore's law is not dead. So here's another way to substantiate this claim that I made. What you see on the screen here is the Bloomberg news feed as it comes into our infrastructure. So this is very early morning in the United States, but as you can see, the feed is already quite active. It's fast enough that people can't really read this. And all the way back in 2007, we were already contending with over 250,000 news stories per day. Right? At that time, it was about, I think, 20 different languages, right? And maybe a couple of tens of thousands of different sources. Nowadays, we routinely ingest over 2.5 million stories per day in 40 different languages, in something like 150,000 different sources. So to put this into perspective, I teach at Columbia in addition to my job at Bloomberg, and my colleagues at Columbia had estimated that the overall total number of news stories written anywhere in the world on a daily basis is around 3 to 3.5 million. So we take in about 3/4 of all news written anywhere. Right? At peak volume, this is about 1,000 stories per second. Right? So naturally, this is more text than any human being could possibly read, right? And that was true even 15 years ago. So the question that was posed to us back then was, how do we build tools for people to take advantage of this information? Because there is valuable information which is being communicated to the market via this stuff, right? And I will substantiate that with some of the things that I'm going to show later in the talk. So how do we build tools for people to take advantage of this without them having to read all of this text? Right? And this is where machine learning and artificial intelligence comes in. And this question led to some of the first applications of these technologies at Bloomberg back in 2008. And this was before ChatGPT, before DALL-E, before deep learning took over the world, before anyone really knew what machine learning was or what it is capable of. All right? So we have been at this for quite a long time. The world was a very different place back then, and most of the technology that I will show today had to be built from the ground up. So this is not very useful, right? This is good to do like a Rain Man impression, but it's not really usable, for consuming, this information. So some of the first applications of this technology had to do with search and alerting, right? So to search, you need to know what the story is about. So, for example, maybe you are an equities analyst and maybe you're interested in Apple. So nowadays, you can basically just say something like this. And this machine needs to understand that this is Apple the company, not Apple the fruit or something like that, right? And maybe we're interested in its products. And maybe we want to know what's happening in China. And maybe we are interested in social media content. And maybe we want to know what happened during the announcement last month or something like that. Right? So this shows quite a lot of technology all at the same time, right? So what has to happen on the back end is that all of these stories have to go through an NLP pipeline that attaches a variety of different metadata to this content, right? Things like industry classification and company names and products and geography and people, and et cetera, et cetera, et cetera, events, commodities, currencies, corporate actions, and so on. And we have to do this at 1,000 stories per second, right? In parallel, in many, many different languages and formats. On the front end, what needs to happen is this machine needs to be able to take in a query string like this and extract meaning from it. So what is a company? What is a news source? What language is this in? Time periods, etc. So this is a very hard problem, right? And we have to do this not just in English, by the way, but also in Japanese and Chinese. You can type in queries like that in other languages. And I want to emphasize one important point. None of what I'm showing right now is using something like ChatGPT. All of this was built before GPT models even existed, right? So This is not limited to just news. You can do this for other things like companies. So, by the way, notice also that as I'm typing, the suggestions change. So we don't have to do just recognition, we also have to do synthesis, right? So some of you, of course, are Bloomberg users. So for example, how about this? So how would you answer this question, just hypothetically? Well, there is a way to do this on the Bloomberg terminal. It requires about 20 clicks, right, and knowing where to go. I once asked this question to a room full of Bloomberg users, about 200 people, and 2 people raised their hand. Right? So naturally, this is a massive improvement in human workflow, right? So now you don't need to know how to do this. You can just type this in, right? Notice, by the way, that the query is ambiguous. So it could be referring to fixed income securities or to equities. So there is an additional machine learning problem to rank the results, right? So there is quite a lot of technology that goes behind something like this. Old-time Bloomberg users would appreciate how much easier this is, compared to how it used to work. Now, other ways that you can use this is, for example, to put together charts. So say something like, right? This is much, much easier, right, than doing this by hand, of course. This technology is applied in other ways, right? So let me show you one other example. This is a table of all the Apple's financials over the past couple of years. Here is its last year's results. Here is its full year revenue for year 2022. Here is that revenue broken out by type, right? And this is a link to the document where that number came from. Not only the document itself, but also where in the document that number came from. Here it is, right there. Now, for a long time, people had a deeply unenviable job of having to do this by hand. Look at PDF documents and manually copy-paste numbers from documents into forms, right, for us to be able to do this. And that has to be the most boring and annoying job in the world, right? So years ago, somebody in our engineering group had this unique bit of foresight to save this transparency information, not just to the document, but literally down to the coordinates within the document. And by virtue of this workflow, we ended up with tens of thousands of these documents, which are annotated in this ultra-detailed way. And I am a mathematician, right, and I'm an artificial intelligence researcher. I look at that data and I see training data that I can use to build a statistical model that will do exactly the same thing. So this was actually an intern project, believe it or not. Somebody in CTO office did this in a summer, right? Now there is a neural network that looks at this document and does it in one shot, the whole thing, right? So it takes a document and outputs an Excel spreadsheet, right? So this shows you what can be done, right? If you have the tools and the technology and stuff like that. I don't have a lot of time left, so I'm going to skip over a few things. There's many, many other things I could show you, right? Including things like summarizing documents. So for example, if you can get at a glance view into what's going on, on any arbitrary topic. So for example, something like, there is a great deal of discussion about debt ceiling in the United States. All right, so this is output of several different machine learning models which cluster documents together and then do summarization right? So these white pieces here are actually synthesized by a neural net. This is not written by a human being. This is written by a machine, right? As you can see, the range of applications of this stuff in just this narrow part of finance is already quite vast. And at this point, no matter what part of the investment workflow you look at, it has been automated using machine learning by someone somewhere. Factor construction, portfolio construction, risk, strategy development, execution, name it, anything you can think of has been done somewhere. So it's a fascinating time to be an AI researcher and engineer because our capabilities are growing and growing more and more rapidly. So you may have heard of ChatGPT. It's hard not to, right? It was a massive, very expensive undertaking to build a system like that 2 or 3 years ago. You may have also heard of Bloomberg GPT, which is the first GPT model that was built specifically for finance. And we built it last year using a relatively small team and a relatively modest budget. Substantial, but still modest. And now a model like that, while it is still out of reach to build for most of our customers, right, it requires quite a lot of data computation and know-how, is possibly going to be available to our customers, and you don't need to build it. You will be able to just use it, and use it without writing code. So that's a very important thing to keep in mind, right? The facility of using this technology now is completely different, and this opens the door to kinds of things that were simply impossible a short time ago. Right? We can use this model for many, many things which are very difficult to do otherwise. So question answering from documents, customizable summarization, knowledge-based construction, code generation, that's a very important one, reasoning, et cetera, et cetera. So the barrier to entry to use this technology keeps going lower and lower. Now, I don't have time for questions in this session, but I hope you enjoy this. And I'm happy to answer any questions offline later today and tomorrow. Thank you.
Thank you, Gary, for a very interesting presentation. May I invite our panelists for the second panel to come on stage? So I think we need an extra chair. So we have a second panel on emerging markets, and this time we're going to get the perspective from emerging markets. So please have a seat. Thank you.
Lena.
So let me introduce our panelists first. We've got Sheikh Alwaleed Al-Thani, the CEO of Investment Promotion Agency here in Qatar. We've got Lena, who is the President and CEO of Developing Capital for Africa. We've got Sheikh, who is the co-head of Banking, Capital Markets and Advisory, Middle East and Africa at Citi. And we've got Kristian Feldborg, who is CEO, founder of Vesuvio Labs. Thank you so much for joining the panel to give us your perspective on emerging markets. I'll start with Rizwan, actually. So Rizwan, you look at 60 emerging markets in your role. How do you scan them, and how do you classify them, and how do you put them in different buckets? How do you look at emerging markets? What's the broad picture?
Sure. So the reason why we cover 60 markets is because we have been in emerging markets for decades. This is a presence that's been built over 50 plus years here in the region. And it's something that we cherish, and it's a real differentiator for us. Emerging markets is they're very diverse. It's very hard to group them into one region. And the way we think about the region, at least from a Middle East, Africa, and Central Asia perspective, is there's the high beta countries and the low beta countries, broadly divided into those categories by whether they are commodity exporters or commodity importers. The opportunities, the challenges, the requirements, the services needed by our clients in those countries vary a lot, depending on which category they sit in. But fundamentally, I think what's critical for our clients in these markets is access to capital. And that's another lens you can look at these markets. If there is ready access to capital, that's usually in the low beta markets. and access to capital is a little bit more challenged in higher beta markets. So our approach to emerging markets is through those lenses, and we obviously gear up our efforts and resources accordingly. If you look at the region we are in right now, in GCC particularly, markets have been as readily available in terms of access for most issuers as anywhere in the world right now. If you look at debt capital markets this year, global emerging markets issuance is up 80% over last year. 50% of that has come from Middle East. So what that points to is that there are certain parts of emerging markets which are completely locked out of capital markets. And that's where the kind of services required and solutions needed are very different. And we work with our partners in MDBs, multilaterals, to facilitate access to our clients in those markets. And that's another big theme that we have to, if we have time, we can talk about is how do we facilitate that access to capital in those markets. And then the second aspect of capital is equity capital. Again, that's an important source of capital for taking companies to the next level after they've been incubated through private capital. To facilitate even private capital coming in, there needs to be an exit for that capital into the public markets. And that is a key component of the further maturity of these markets. And we've seen that happen here in the region, particularly in Saudi and in UAE, which have been actually since 2022, if you look at the stats across EMEA, more than 50% of primary issuance has happened in those markets across EMEA, which is something that you would not have anticipated a few years ago. But that kind of a capital access needs to be made available more broadly in emerging markets to take those markets then to the next level after they've achieved the basics around debt sustainability, access to debt capital, either directly or through support with multilaterals. So that's broadly how we think about the region and how we cover our clients here.
Sounds interesting. So, Lena, let me move on to you. So, Rizwan mentioned one way he looks at the space of emerging markets that he scans is dividing them into commodity exporters and commodity importers. You look at the whole region as well, which is sub-Saharan Africa. Do you use the same classification, or you have a different way of looking at things?
Well, thank you so much. It's a pleasure to be here. I was here last year, and wonderful event. So, I think a lot of people look at right now with the crisis in Ukraine. I think people, overestimate the impact on the ground. I think we talk about statistics. The IMF, the latest report, they said that they're expecting the sub-Saharan African region to grow in 2023 to 3.6%, and 2024, 4.2%. So it's, despite what's happening in the rest of the world, we're actually seeing African countries, actually 4/5 of the sub-Saharan African countries will see growth between this year and 2024, compared to 1.7 for 2024 in developed countries. So it's moving. I mean, it definitely has a real impact on food prices, for instance. So some countries definitely suffer more than others, but overall, I think it can be quite optimistic in looking at opportunities in different markets. Again, it's very diverse. For instance, Senegal is expected to grow by 2024 10.2% GDP growth. Why? Because of huge discoveries of oil and gas recently. And South Africa is 1.2% in comparison. So there's definitely disparity. So it's important to actually look at markets separately.
So growth overall in the region,
54
disparity,
countries.
and some are growing faster than others.
Exactly.
Let me move on to Sheikh Ali, and then the way people think about Qatar and the GCC and the global economy, they think about it in two ways. The GCC and Qatar are providers of energy to the global economy, And when oil prices and gas prices are high, they're also providers of capital. Now, you try to attract investments into Qatar. How has that been going? Give us the trends. Has it been coming in? Has it been coming to sectors other than energy? What sectors is it coming to?
Yep. Thank you, Ziad, and very happy to join this panel today. This is my third participation in Qatar Economic Forum from the very beginning. To your question regarding how has Qatar performed generally, and if you look at the region, really the GCC has been the bright spot, especially when it comes to FDI. Qatar last year, 2022, registered an inflow of around 29.7 billion US dollars into around 135 different projects, creating around 14,000 jobs. What's really interesting as well is when we look at where this investment is going. And across this 135 different projects, oil and gas make up around 9%. The majority went into business services, ICT, healthcare, and different diversified sectors. I think this is testament to kind of how far Qatar has come. And if you really look at Qatar's growth story, I mean, from the development of the oil and gas industry to the development of the infrastructure, from the airport to the ports, the largest green and deep water port in the region, air cargo and logistics. And now in the kind of next phase where the focus really is on human capital. And His Excellency, the Prime Minister, said it very eloquently today about how Qatar made that investment pretty early and how that investment is now bearing fruit. And so we see businesses not just come here because of energy competitiveness, which is there, or infrastructure, but because of the human capital available in Qatar, the ability to attract human capital from the wider region, and that builds on our value proposition as a country. So, our pipeline is stronger than ever. I mean, yesterday, I was happy to be there for the announcement of the launch of Google Cloud region in Qatar. Tomorrow, we have a number of projects we will be announcing. And really, I mean, we see great momentum, and especially post-World Cup as well, that has really done a lot of heavy lifting for Qatar.
And this inflow of funds that come into Qatar to establish a hub for the region or to serve the domestic economy?
Yeah, definitely. Qatar's and small countries similar to Qatar in terms of characteristics always need to have kind of an outbound approach to FDI. Is that while Qatar has a great market, but there's an ability to scale from Qatar, and especially within a partnership model. And I think this is kind of the underlying trend. I mean, when you look at Qatar, both on the buy side, I mean, when we invest abroad, or on the sell side, or in energy, there's this broad concept of having a long-term partnership, which I think investors value. And not just partnership with us as an organization, but whether it's with state-owned enterprises, with the broader private sector, and the ability of the government to be responsive to the needs of the businesses and the private sector. And via this kind of partnership, there's an ability to not just scale and come here for the market in Qatar, but look at Qatar as a launching pad. I mean, we sit in the middle of a number of high growth regions, whether it's Central Asia, Africa, and South Asia. And this is really, I mean, adds to our value proposition as well.
Which countries are they targeting in terms of being a launching pad too?
Yeah, so it's pretty diversified. I mean, some look at Qatar as a hub towards the Gulf region. Some look at, fragment the Gulf into North Gulf, South Gulf. Others look at Central Asia as well, which is an emerging market. Qatar has really invested in the infrastructure in terms of trade and transport links there. South Asia and Africa. So really, I mean, depending on the business, depending on the sector as well, they have a divergent set of target markets.
That's very interesting. Kristian, I'll move on to you. Tell us a bit about the venture capital industry. What do you see and the geographies you operate. Which geographies do you operate in emerging markets?
Yeah, so we're from the UK originally. So we are a startup incubator. We're a venture builder. So we're not a traditional venture capital company. We are a company that takes entrepreneurs and at a very early stage, and we work with them, build their businesses, get them to market, build their products. So in a way, we are always in an emerging market, even in the UK. So while we're here, we also have an office here in Doha. We've got a lot of support, among others, from Sheikh and his organization. We're here for two reasons. One is market, like you mentioned. So the companies that we work with, of course, as they reach a certain maturity level, are looking for other markets to enter with their products. But perhaps more excitingly, we are also looking for opportunities to work with local entrepreneurs, build new businesses for more local needs or local flavor, and grow those companies. So that's the area that we are really excited about, working with countries like Qatar, engaging with that ecosystem that isn't just about venture capital. Venture capital is important, of course, because that's the fuel for the factory, but universities, entrepreneurs, corporates, public sector, all of those constituents of the ecosystem we try to engage with, try to create an environment where we can build successful businesses that can grow in Qatar and in the region and in the world, hopefully.
That's interesting. So can you just tell us also what is attracting you to, so in this region you operate only in Qatar, right?
Yes.
Okay, so what is attracting you to Qatar? And also, I think part of this forum is to find solutions. So tell us also what challenges, and maybe you'll be able to resolve them here.
Yeah, well, please, yeah. So why did we come here? We came here because there are obviously alternatives. So lots of companies from the UK at the time would have gone to Dubai, for example, with a more developed ecosystem at the time. I think I came here for, there was a more kind of collaborative feel to it. When I engage with different organizations in Qatar, it's very personal. You're welcomed, they try to help you, they try to work with you. And what we are trying to do is quite difficult. So it's nice to be in an environment where there are people that are really, really trying hard, taking it seriously, excited about what we are trying to do. What's missing? What do we need? I think early stage venture capital is a gap. I think there are accelerator programs that are there, that are working well. There are there's of course later stage capital availability here. I think that bit in the middle with the capital needed for a company to build a successful viable product is a key priority for us at the moment, and that's what we're trying to do, set up that fund.
In terms of concrete things you'd like to see, what kind of things are you looking for?
I mean, concrete things is money, right? You know what I mean? You need a more efficient way of deploying that capital, because someone has a good idea that you have to be able to test it out relatively quickly. It should not take 3 years, right, for you to discover whether or not you had a good idea, and 25 other people have already done it. So that's a key challenge is to get that seed capital deployed more quickly. That obviously is something many of us are trying to work towards a solution for.
Very interesting. Lena, can I move on to you? In the spirit of identifying challenges and trying to find solutions to them, Africa has always had the potential to grow. And again, I'm not talking about in the whole region, but maybe we can pick certain pockets as you wish. What challenges, what do you think are the priority challenges that the subcontinent is facing? And what is your sort of recommendations to address them? What are the key things that you'd like to see?
And I think that goes directly to what Kristian said, access to finance, especially for SMEs, small, medium-sized enterprises across the continent. In order to keep driving growth, we have to invest more in SMEs. And it has to be an ecosystem, like he said. It's not just traditional banks. It's not just aid from the government. You have to have other actors, private equity funds, need to invest more in entrepreneurs. I think that is one common theme when you look at the sub-Saharan African context. That is a really serious challenge, but also an opportunity, because there are more and more private equity funds that see that they need diversification, they need to come in new markets. So we're definitely seeing a positive trend that will help drive, grow the middle class.
And are there particular bright spots, either in countries or certain sectors that you've observed?
I'm sorry?
Are there any bright spots, either in particular countries or sectors where you can see SMEs are growing and they're addressing the challenges?
Yeah.
Can you just give examples?
Some of the sectors that's growing very fast, it's in agribusiness. So agribusiness, I think the whole world understands that we need food for the, not just in that part of the world, but African countries can actually feed the rest of the world. So that is a big sector that is growing, that is attracting European funds, American funds are coming. So that's one sector. Another sector is new energy, renewable energy. That is also, we're seeing more and more interest in that sector.
That's interesting. Sheikh, I can ask a question. So some countries and places around the region, there's this geopolitical sort of earthquakes happening around us in the world. We've seen, for example, a place like Dubai has benefited from the war in Ukraine, in the sense that oil prices did rise, that you had an inflow of people from Russia and Ukraine, you had an inflow of capital. Is Qatar benefiting from the geopolitical environment around us globally?
Yep. I think, this is a question as well that's pertinent to all emerging markets. The current trends in FDI when it comes to reshoring, friendshoring, will impact countries, or there will be a divergence in how that impacts different markets. And the GCC really has been a beneficiary, being the ability to, or kind of creating the platform where we maintain relationships with the rest of the world, and being a stable, neutral platform for business and trade. And that is a very conducive model when it comes to attracting FDI going forward. And it's not, I do not really see it as a competition. Competition is good in a certain way, but as well, Qatar really benefits from the development of its nexus markets, whether that's the UAE or Saudi Arabia, or even other markets in Central Asia and North Gulf that have yet to meet its full economic potential. And when you talk about kind of challenges, I think this is the biggest challenge we face, which is a challenge that is very exogenous. It's something that you really have little control over, but there are ways to mitigate for it. Qatar has made a lot of investments in the past when it comes to resiliency and building resiliency within a market. So whether that's food security, where we transitioned from being a net food importer, importing around 85% of our food, to now being an exporter, but not just an exporter, but even exporting our food security model as well. Resiliency is going to be key in how emerging markets benefit from the kind of current geo-economic situation, and government responsiveness to change. And I think these kind of two factors would be one that emerging markets really need to look at and how they adopt and how they kind of navigate the shifting geoeconomic trends.
Very interesting. Rizwan, can I ask you, the one thing that came up is capital and money and raising capital, and that's important for businesses and economies. And you do that, debt and equities across different, you mentioned 60 countries. Which countries are doing it right? Which countries are setting up the right financial infrastructure to raise capital, be it in debt or equities?
So if you look at the region, the access to capital is barbell shaped right now. So you've got GCC, most of Middle East, some parts of Central Asia, Central Europe. I think they have full access to markets across different formats. Domestic liquidity is high, so there's ready access to capital. That's not a concern. And then there are parts of the region, particularly in sub-Saharan Africa, which are locked out of the markets. And the biggest issue there, in my mind, is debt sustainability. These countries have been buffeted by post-COVID. All of the events that have created the crisis in a lot of these countries are not, they're beyond their control. They have been impacted by them, whether that's the war, whether that's the US interest rate environment, food security and inflation. Debt sustainability needs to be resolved very quickly for these markets. Otherwise, they go into a downward spiral, and it's very difficult to bring these markets back out of that spiral. And that's where, what I mentioned initially, the role of development financial institutions, multilaterals, they need to play a much bigger role in ensuring that debt sustainability, if restructuring is required, that needs to happen very, very quickly and much more seamlessly. In the previous panel, we talked about Zambia tried. We have a framework, it just doesn't work. So there needs to be a better method of resolution of some of the debt sustainability issues. And then everything flows from there. Once you have debt sustainability at a macro level in a country, private market access opens up. Because if you look at the world today, where would you go and invest today in terms of emerging markets? The demographic dividend that is expected out of Africa and the imperative of that demographic in the next 5 to 10 years is not really fully priced or recognized by markets. And once that is fully understood and some of these big sustainability issues are addressed, I think that's really where the growth in the future is going to come from. So, from a market perspective today, markets are very simple in terms of they look at relative value, they look at the risk in these markets, and they invest on that basis. Allocations happen. So if you adjust some of these fundamentals, give markets confidence, that access comes back very quickly.
And of course, in our world, this sustainability and resolution of debt is more complicated by the fact it's not just the Paris Club or the IMF or the World Bank. You have China and what is happening there and themes we discussed in the first panel. Unfortunately, we're out of time for this panel and for the whole session. Please join me in thanking our panelists for their excellent views and session.